Hello, friends. April 15th has come and gone, and most people assume that once the filing deadline passes, the IRS closes the file and moves on. It does not. What is happening right now, in the weeks after tax season, is that the IRS is running its automated matching systems, comparing what you reported against what every bank, every brokerage, every payment platform, and every government agency reported about you. This is not a small operation. This is the largest data matching engine on the planet. And if your numbers do not line up perfectly, the IRS does not call you to chat. The IRS sends a letter. That letter is called a CP 2000 notice. And it is not a suggestion. It is a bill. It is a demand for money, plus penalties, plus interest. And the people who subscribe here know about these matching runs before the letters go out. The people who do not subscribe find out when the mail comes. So subscribe now and let us get into it. Let us start with the one that surprises people most, because it involves money most seniors assume is completely safe from the IRS. Social Security benefits can be taxed, not SSI. Supplemental security income is never taxable, but retirement benefits, disability benefits, and survivor benefits are all potentially taxable at the federal level. Here is the rule that nobody tells you. If half of your Social Security benefit plus all of your other income, including wages, pensions, IRA, withdrawals, and investment income, exceeds $25,000 for a single filer or $32,000 for a married couple filing jointly, the IRS begins taxing a portion of your benefit. Above those thresholds, up to 85% of your Social Security check can be pulled into taxable income. And here is the killer. The income thresholds used to trigger these taxes have never been adjusted for inflation, not once since the law was written. So while your Social Security check has gone up every year thanks to COLA increases, those COLA increases have quietly pushed millions of seniors above these old, outdated thresholds. You did not get a raise. You got a tax trap. And the IRS does not send you a warning letter when you cross that line. They just wait for your return to arrive, and then they compare it against the Social Security Administration's data. If you missed reporting a portion of your benefits as taxable, they will catch it, and they will adjust your return automatically. That adjustment often comes with penalties. So what do you do about this right now? You have two moves. First, look at your combined income for last year. If you are close to the threshold, consider using Form W-4V, which is the voluntary withholding request for Social Security payments. You can ask the Social Security Administration to withhold federal taxes from your monthly benefit at a rate of 7%, 10%, 12%, or 22%. This is the cleanest way to avoid a surprise tax bill next April. Second, if you are already retired and you have not been withholding from your Social Security check, start now. Even 7% withholding can save you from an underpayment penalty. The people who wait until they get the CP 2000 notice are the people who pay interest to the IRS. The people who act early keep their money. Now let us talk about the form that is terrifying more seniors than anything else right now, the 1099K. You have probably heard about the new reporting threshold for online payment platforms. Starting with the 2023 tax year, any online sales over $600 on platforms like PayPal, Venmo, eBay, Etsy, and Facebook Marketplace must be reported to the IRS. That does not mean that every dollar you received is taxable, but the IRS does not know that. They only see a 1099K form with your name and a total dollar amount. So when their automated matching system runs in the weeks after April 15th, they will compare your tax return against every 1099K filed under your Social Security number. If you did not report that income, or worse, if you did not even know that form was coming, you will get a notice. And here is the part that breaks people's brains. Even sales of personal items at a loss, like selling a used couch for $200 that you originally bought for $1,000, still get reported on a 1099K. That sale is not taxable because you did not make a profit. But the IRS does not know that unless you tell them. You must report the gross proceeds from the 1099K on your tax return, and then you must subtract your cost basis to show that no taxable gain exists. If you ignore the form, the IRS assumes the entire amount is profit and they will tax you on every dollar. This is not a bug. This is how automated matching works. The system does not know intent. The system does not know fairness. The system only knows numbers. So your job right now is to gather every 1 099K that was issued for your online sales and make sure your return either included that income. Next, we have to talk about cryptocurrency because the IRS has made it very clear that digital assets are a major enforcement priority. On your tax return, you will see a question that says, at any time during the tax year, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? This is not optional. You must check yes or no. And here is what happens after April 15th. The IRS is matching your answer against data from major crypto exchanges like Coinbase, Binance, and Kraken. If you traded crypto and you checked no, you will get a notice. If you checked yes, but you did not report your capital gains or losses, you will get a notice. And if you thought that moving crypto between wallets or using decentralized exchanges meant the IRS could not see you, you are wrong. The IRS has contracts with blockchain analytics firms like Chainalysis that track every transaction on public ledgers. They are not looking for small traders, but they are looking for patterns. A single unreported crypto trade with a large gain can trigger a full audit of your entire return. So what do you do right now? First, pull your transaction history from every exchange you used. Second, calculate your gains and losses for every trade. Third, if you already filed and you made a mistake, file an amended return immediately. The IRS has a special voluntary disclosure program for crypto, but that program is only generous before they contact you. Once they send that letter, the penalties become severe. Do not be the person who ignores the crypto question. That is the easiest way to get a full audit. Now let us talk about one of the most painful hidden consequences of large IRA withdrawals. This one destroys people who take a big distribution to pay off debt or buy something important. They think they are just paying tax on the withdrawal. But that is only half the story. The other half is Medicare premiums. Medicare Part B and Part D premiums are based on your modified adjusted gross income from 2 years earlier. This is called IRMAA, which stands for Income-Related Monthly Adjustment Amount. If your income goes over a certain threshold, you pay a surcharge on top of your standard Medicare premium. In 2024, the base Part B premium is about $175 per month. But if your income 2 years ago was above $103,000 for a single filer or $206,000 for a married couple, your premium jumps to $245 per month. At higher income levels, it goes up to $560 per month. And here is the trap that nobody warns you about. If you take a large IRA withdrawal in 1 year that pushes your income over these thresholds, you will not feel the pain that year. You will feel it 2 years later when your Medicare premium doubles or triples. And there is no automatic forgiveness for that. But there is a way out. You can appeal the higher premium using Form SSA 4.4. That form allows you to explain that your high income was due to a one-time event like a large IRA withdrawal, a sale of property, or a retirement distribution. If the Social Security Administration agrees, they will reduce your premium back to the base level for that year. But you have to file the appeal. They do not offer it. They do not remind you. You have to know the rule, and you have to act. So here is your action plan. If you took a large IRA withdrawal in the last 2 years, look at your current Medicare premium. If it seems higher than expected, download Form SSA 4.4 from the Social Security website. Submit it with proof of the one-time event. And if you are planning a large withdrawal for this year, understand the 2-year delay. You might want to spread the withdrawal over multiple tax years to stay under the IRMA thresholds. A little planning today can save you thousands of dollars in higher Medicare premiums for years to come. Now, let me shift gears and talk about something that is not in the tax code but is destroying people financially right now. AI-powered IRS scams. Scammers have stopped using broken English and fake badges. They are now using voice cloning technology to imitate IRS agents, tax preparers, and even family members. Here is how it works. You get a phone call that sounds exactly like an IRS agent. The voice is calm and professional. They tell you that you have an underpayment from last year's tax return. They give you a badge number, they give you a case number, and they say that if you do not pay immediately by wire transfer or gift cards or cryptocurrency, a warrant will be issued for your arrest. This is a lie. The IRS does not call you to demand payment. The IRS does not accept wire transfers or gift cards or crypto. The IRS does not threaten arrest over the phone. The IRS initiates almost all contact by mail. A real IRS notice comes in an envelope from the Department of the Treasury. It will never demand payment on a phone call. It